Get ready for Monday Mortgage Minute with your hosts, Tom McNamara and Bruce Woodburn.
All right. How are you?
I am awesome. How are you?
I'm doing great. It was a great weekend. Got a lot of business came in over the weekend. And I think we've got some important things to talk about today for consumers or other real estate agents, people interested in entering the market. There's two things I want to cover with you today. One of them is DSCRs. We're going to explain what that means. And the other one is going to be bank statement loans. Very, very popular with the investor group and self-employed people. So I want to get started on that with you. I think there's a lot that people can learn from that.
Yeah. So DSCR. I actually have a DSCR loan on one of my properties, and it's in. I don't remember what the detail was of what I needed ratio wise, but what exactly is it? Like debt service coverage
So
ratio.
it's
So
a debt service. That's what it stands for, is debt service coverage ratio, which really means that your mortgage payment and the rent you receive should be approximately a 1-to-1 ratio. So if your payment's 3,500, then your rent's got to be at least 3,500 bucks. So that's a standard 1-to-1 ratio that we use. A lot of other companies want a 2-to-1 ratio, which is insane because then you need your rent to be twice as much as your mortgage payment, and that is nuts. It just never does happen. But we also have a specialty program that we only need 75% rent to mortgage payment.
That seems kind of crazy. I mean, I don't even really understand why you would only want a 1-to-1 ratio because, you're not factoring in any of the other expenses like repairs and maintenance and vacancy and all that stuff, right?
Absolutely.
So
Absolutely. These are non-QM loans. They don't meet Fannie Freddie guidelines. And the reason people will go with a 75%, some people would buy even lower than that. They just can't get financing for it, is because investors are about 30% of the market right now. Why do you think investors are 30% of the market?
well, because house prices are high and wages haven't caught up.
Well, they also are not they know that we're going to see some appreciation in the future. They know that right now things are relatively flat, so investors don't mind having a little negative cash flow because they're going to sit on a huge amount of equity. As soon as these rates drop, they know what they're going to get, right?
Right.
So they don't mind a little negative cash flow. But for those of you that don't want negative cash flow, you need a 1-to-1 ratio, and that's really where that comes in.
Or higher, right? So,
Yeah.
all right. So if I'm buying a house DSCR or refinancing, I actually did mine with
Yep, you can do a refinance.
um,
Absolutely.
what is the down payment?
Down payment's usually going to be between 20 and 30%. You can do 15% down in some programs if you have high credit scores.
Okay, all right. So it's pretty standard essentially for an investor loan. Usually
Yep,
you
very
want more.
standard, very easy. It's very simple.
Yeah. And then what kind of terms? I mean, is this like a short term? Is it an ARM?
No, you could do adjustable rates. You can do loans with prepayment penalties or without. Most of the time, when you looks at DSCRs, they're going to come with a 3-year prepayment penalty, but the consumer can buy the prepayment penalty out. In other words, you don't you the best rate would be with a 3-year prepay. You pay a little higher rate, I'll give you a 2-year prepay. You want to pay a little bit higher rate, you get a 1-year prepay. You want to pay a little higher rate, you get no prepay. So you can adjust it based on what you want. And a lot of people would rather just go with a 2-year prepay because they know that rates are going to drop in the next 2 years. So
Right.
they go with a 2-year prepay. That way, when rates drop, they can refinance.
Yeah. Yeah. Okay. All right. So
And mostly 30 years.
mostly 30 years. Okay. So if I already have one, can I have another?
Absolutely. You can have as many DSCRs as you want. There's no limit to them because I don't have to use your tax returns to qualify you like a traditional mortgage. So, in other words, if you had to, and you had 10 properties out there and half of them were negative cash flow, you may have a challenge in qualifying. So, we're only looking at the one you have. Now, that doesn't mean we don't list your schedulable real estate on the application,
Right.
but we're only looking at that property for the income versus the mortgage payment.
So are you going to pull my credit?
Yeah, absolutely. Because credit score matters. Credit score matters a lot. I mean, it determines, what the likelihood of a person paying back a loan and paying it back timely is going to be.
Sure.
So the lower your credit score, and usually these are the floors about 680. You
Okay.
know, they're not for irresponsible people. They're for self-employed people or people that just don't want to show their income, or they have a lot of write-offs and it would not qualify them if they showed their income.
Right. Okay. And then is this for my business or is it personal?
Yeah, you're not going to do these personally. In most cases, there are some DSCRs that may allow you to buy it as an individual or refinance it as an individual, but since they don't meet QM, quality mortgage guidelines, that are set forth since 2010 to keep people from getting involved in predatory loans or, things that might be negative, they don't meet those guidelines, so they're truly done more as a commercial loan. That's why you want to buy or refinance them in the name of an LLC.
Got it. Got it. So what if I don't own a home? Can I buy a property with a DSCR loan?
That's a great question because we get that a lot. I have a client right now. The guy's making gobs of money, but he doesn't own a primary. You cannot generally get a DSCR unless you already own a primary. So I'm trying to get this guy into a primary in Washington State, which is where he lives, so he can get DSCR loans down in Tampa where he wants to buy. So, but he can't get those until he's got his primary. And the reason for that, Tom, is that lenders want to make sure that you're not lying, that you are truly going to use this as an investment property. Because if you moved into it, then you have skirted the QM guidelines, and that could turn into a mortgage fraud situation. So you don't want to play that game.
All right. So what if I get a DSCR loan and down the road, hey, I'm going to move into this rental because I like it or I want to sell my primary.
That's fine. You can do that. But the intent was not to do that. So the intent at the purchase was as an investment property. 12 months down the line, nobody really cares, because if you had it rented out for 12 months and then you moved into it, there's not really going to be any consequence to that.
Got it. All right. So what are the disadvantages then? Because it sounds like a great loan.
Well, the disadvantages may be, if you're thinking about that, would be a little higher down payment. So on a traditional investment transaction, you can put down 20%. Well, you can do that on a DSCR, but your rates start to get better, just like a conventional loan. The more you put down, the better your rate's going to get. And it's not that much better, but it's a little bit better.
Huh?
They require a little better credit scores. They do come with prepayment penalties, but like we said, you can buy those out. So those may be a disadvantage. And the interest rates are going to be a little bit higher.
So on average, if we're looking at 7% rates for a conventional, what are we looking at for a DSCR?
8%,
Okay,
8.25.
about a point,
Yep.
a quarter.
Yep.
Okay. All right.
Depending on credit score. I got one locked in. We locked it in about 3 weeks ago before we had the market crash on us. And I think I've got him on a DSCR at like 7.125%. Now, that was back before rates popped up again. But still, they're not horrible rates. They're really not. And it's so easy for the self-employed person. It just makes things so much cleaner.
Yeah.
And you and I both know self-employed people, they want to write everything off. They make $500,000 and they show that they made 15 grand, right? So
Right.
nobody's showing that they're making any money, so they don't pay any taxes. So these are a great opportunity for people to buy investment properties.
Okay. All right. So there's the other loan program you wanted to talk about, which is a bank statement loan.
Yeah. So bank statement loans are very popular. You can do those as investment. You can do them as second home, as primary residence. Those, again, also are for self-employed people. Okay.
Right,
So
right.
you've got to be self-employed. You can't do a bank statement program as a W-2 unless if I have a company and
Mhm.
that company is showing me income and I can supplement it if my wife has a W-2 and I'm self-employed, or if I have a part-time job, I can weave that in, but you're
Gotcha,
only going to allow them to use one company other than the self-employed business. So
gotcha, gotcha.
yeah, so but it can be used for any type of a program, and it again avoids clients coming up with their tax returns because they know they walk into a bank or a mortgage company and they're just not showing any net profit, and so we want alternatives for those type of
Sure.
people.
And then you got those kind of people that don't file tax returns for 2, 3, 4 years at a time, you know?
I don't advise that,
I
okay?
don't
Because
either. I don't
e-
either, but, you know,
even
they're
if
out
we're yeah, and here's the thing, even though lenders may not require to see your tax returns, they may pull a records of accounts from the IRS
there.
to
Okay.
make sure you do file.
Gotcha,
So, yeah,
gotcha.
don't not file your tax returns, folks, and thinks that there's alternatives. You could be forced into hard money, which is a whole new level from
Oh,
this.
yeah, yeah, yeah. We don't talk about hard money.
Well, we can talk about that. I mean, listen, some people need it. I mean,
I use hard money on every flip I
we
do.
use hard money a lot, right?
Yep, on every flip I do. So, all right. So who's going to use a bank statement loan?
Generally, your self-employed person that maybe owns their own business or is in partnership in a business. Uh, they make good money. They have decent credit. They've got a good savings account, so they can put down a nice down payment. They just don't show any income on their tax returns.
Right.
So they provide me with their last 12 months bank statements. Now, some mortgage companies and banks require 24 months. I require a minimum of 12 months. You have to have been in business for 2 full years, and we're going to check public records to make sure you have. So incorporated or that LLC for at least 2 years. So you want to make sure that you can show that you've had a business for at least 2 years. I'll look at 12 months worth of bank statements. I'll add up all the deposits. I don't add in transfers. So if you transferred from one account into your business account, I can't count that as income because it was already money you'd received. So a lot of people look at that and they forget and they go, oh man, I keep putting money in for my other account. That's going to be removed. So let's just say we had an average of $40,000 a month worth of deposits. I'll use $20,000 a month as income.
Okay. Okay. And you're not looking at my expenses.
I'm not looking at your expenses on your tax returns because I'm not looking at tax returns, but I'd take that $20,000. You're still going to have a credit report pulled. And if you've got car loans and credit cards and all not that, it's going to come into your debt ratio. So
Okay.
remember, I'm just determining income from bank statements. That's all I'm using.
What kind of debt ratio do we, I know with, with regular loans, QM loans, we're looking at, 40, 45, 50%, depending
Yep,
on which
you're
loan
you're gonna
product.
you're gonna run around the same thing. You're gonna
Okay.
cap out at about 50%.
Got
45 is generally more attractive. Remember, when it comes to alternative loans, and in a lot of cases, even traditional mortgages, your pricing increases based on your risk. So
Yes.
it's not the lender, it's you. If your credit score is not as high as it should be, you're going to pay a higher price. You don't have enough money down, you're going to pay a higher price. Your
Right.
debt ratio is a little high, you're going to pay a higher price. So the banks and the mortgage companies don't determine that. You determine that based on your situation.
All right. So speaking of down payment, are we looking at 25, 30%?
Yep. Yeah. And bank statements, you could do some of them at 15% down.
Okay.
It's more advisable. And as I said, rates start to get more attractive. I've even seen some as little as 10% down, but you're probably the points you're going to pay on that 10% down would be better off to put 5% more down.
All right.
Right.
Right. Yeah. Okay. All right. So it sounds like a great loan product, but again, we know there's going to be disadvantages, right?
Yeah, well, so your disadvantages may be a larger down payment and a higher interest rate, potentially a prepayment penalty on them. So
Right.
I recommend that you try to keep that. And the longer the prepayment penalty, and they won't go any longer than 3 years, so that would be the max. But the longer the prepayment penalty, the the lower the interest rate, and you can buy that payment penalty right out if you like.
Gotcha.
Hey, we're running out of time,
Yeah,
my
yeah, I was
friend.
gonna say, we are out of time, man. I wanted to remind
Next week, I
everybody,
wanted to. Yep, go ahead. I
remind
apologize.
everybody that we are in all 50 states, both cross country and EXP. So even though I'm only a licensed Florida realtor, I do have
Anywhere in the country.
absolutely I do business all over.
Next week, let's talk about asset depletion. Rich people not having any income. Let's help.